With oil production slowing down and interest rates squeezing the smaller players, it's becoming cheaper to buy oil reserves than explore for them. The announced acquisition of Pioneer Natural Resources by ExxonMobil could be a $60 billion deal and set off a wave of acquisitions for oil stocks. Shares of PXD jumped 12% when that news was announced, and I've found 5 more energy stocks that could be next. Hey Bowtie Nation, Joseph Hogue here in front of what could be a wave of takeovers in oil stocks and digging into the 5 companies that could be next. Don't forget to join the community by tapping that subscribe button so you don't miss a single episode. And if you want to stay up to date with all the stock market news and trends, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter. Before the market opens each week, you'll see all the stock market news and trends to get ready for the week, along with the stocks I'm watching. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Back to our main topic though, because this is going to be the big theme in oil stocks over the next year. We saw that earlier this month that Exxon is agreeing to buy Pioneer Natural Resources for $60 billion, and news is already that other producers like Chevron and ConocoPhillips are also said to be looking for acquisition targets. There are a lot of factors feeding into this that are likely to push the entire sector into a buyout frenzy and setting off that wave of consolidation. You need to know the stocks that could get a buyout offer next. We're looking specifically at target stocks going to be in drillers and explorers with oil assets in the Permian Basin. Now that's in West Texas and New Mexico. This is a major shale oil resources that has been responsible for the U.S. becoming a net oil exporter over the last decade on a really amazing growth in those assets. And we can see that here in this U.S. oil production back to the 1920s. If we scroll down here to this, we can see that huge drop in the 70s when those conventional oil fields just started to deplete. America lost its energy independence, and that's when OPEC really started eating our lunch. But then here in the 90s, you can see this. This is where those shale oil fields came about. That technology behind fracking, those shale deposits, allowed us to tap into those and really see some amazing growth in production. Over the last 10 years, the U.S. has gone from pumping about 5 million barrels a day up to 13 million barrels and has regained that energy independence. Now, the problem is, though, first, those shale resources are now starting to deplete themselves. That boom in oil production and the super cheap borrowing on near zero interest rates brought out all the wildcat drillers, those small independent oil drillers that went wherever they could to find oil, and it was drill, baby, drill. After more than 20 years tapping those shale reserves, though, the oil is starting to run out in those, and it's getting harder to pull the oil up from really depleted fields. That means these fields need the technical expertise and the additional investment, the capital investment, best found with those larger integrated companies. In fact, according to data from Flow Partners, LLC, oil production from the best 10% of wells drilled in the Permian Basin, so this is the very best wells, even the best wells still left in the Permian, that was 15% lower last year than 2017. So oil production in that Permian Basin, even from the best wells, are going down from those depleted fields. That oil production in the U.S. boomed from that 5 million barrels a day to over 13 million barrels over the last decade, but that output last year grew a third the average pace pre-pandemic. And you see this in a lot of the spending plans and the production estimates for a lot of the big players here. EOG Resources, for example, is planning on spending an additional $1.4 billion in its field development versus last year, but it's only expecting production to rise 3% for it. Now take this problem of more expensive exploration and production, and the production that just isn't getting its money's worth with those interest rates that are highest in more than 2 decades, and that means a lot of these fields are unprofitable if they have to put on a bunch of debt just to develop them. Those independent wildcats that were making so much money over the last 2 decades just can't hack it anymore. They can't afford that debt service. Cash is king in oil right now, and the major companies like Exxon, like Chevron, have hundreds of billions of dollars set aside. Exxon had $30 billion in cash as of last quarter. Chevron had $10 billion in cash, but also has another $30 billion in receivables and inventory that can convert to cash for an acquisition. Last factor here is just because of the aging assets of the region, that idea that the Permian fields are nearly tapped out, it's becoming more expensive to drill, to find those assets, and then to get more oil out of them. It's actually becoming cheaper to buy the reserves. Buy the reserves, the assets that are already found, already producing. That's why we saw that Exxon $60 billion deal to buy Pioneer, buying an estimated $2.2 billion in oil equivalent reserves. Now, we do already know that Chevron was reported to be interested in buying Occidental Petroleum, that's ticker OXY, as Warren Buffett's oil company there earlier this year, but that deal fell apart. Exxon bought Denbury for $4.9 billion in July. Chevron acquired PDC Energy in May for $6.3 billion. So looking for these other stocks that could become targets, we want to look for companies with those resources in the Permian Basin, recoverable assets that can be added cheaply to a bigger player. And I want to start here with Permian Resources. That's ticker PR, and I'm going to explain why I'm starting with this one, but you can see the big pop over the last couple of months as we've gotten that heightened interest in acquisitions for these smaller players. Now, Permian Resources is a very much smaller player, only about $8.6 billion market cap. That might affect the decision by the larger players to acquire them. We did see some of those smaller acquisitions earlier in the year, but now it looks like the big players like Exxon, like Chevron, like ConocoPhillips, they're aiming for the big players to really put on that massive size, that acquisition that's really going to add to their resources with a one-stop. Now, researching for the video, I went looking for the presentations for each of these companies that we're going to talk about. Here we can see the asset map for Permian Resources. It does have that strong Delaware and Midland Basin position there. This is actually the presentation for its acquisition with Estes, with ticker ESTE. So it itself is going to be acquiring, merging with another Permian Resources company or Permian Assets company. We see here that in that Delaware Basin, they're in New Mexico and in Texas, as well as the Midland Basin they're in Texas. But here you see on page 13 of the presentation why I wanted to start with Permian Resources. As you dig into the research and the information on these companies, you really find some great information that can expand your research and really show you where you want to focus on these themes. We're looking at themes, we're looking at assets in the Permian Basin, and this one presentation or this one slide here shows us the largest producers in the Permian Basin. It actually shows us by acreage and by rig count who has the most in the Permian Basin that might make for good targets of those bigger players if they're looking to put on these assets. So we can see here PXD now acquired by Exxon there, had 856,000 acres there in the Permian. So obviously that was the largest player. That is now taken out by Exxon. But we look here, we've also got Occidental, we've got EOG Resources, we got Fang, Diamondback, going to be talking about that. We got Devon Energy, DVN has 400. With this acquisition or with this merger between Permian Resources and Earthstone, we're going to create the sixth largest Permian acreage here with 403,000 acres and 11 rigs. So it is going to be a very large player. We can look here in Yahoo Finance for the statistics and the valuation on this. We're going to be comparing valuations on the price to sales ratio across these. We do see here that right now, currently, Permian Resources trading for about 1.8 times on a price to sales basis. We're going to use that to compare against some of our other ones, try to find those assets, not only those concentrated assets in the Permian area, but also the assets at a reasonable price. Okay, we don't want to be paying too much, or a larger acquisition, a larger player isn't going to want to pay too much for these resources. So we want to stick with the ones that have the resources but are at a reasonable price as well. 1.8 times price to sales basis for Permian Resources. We can see that's right around where it has been in the past. 1.9 last year, as low as 1.5, 1.6 times last year. It looks like it is a little bit higher now, just because of that frenzy in the buyout space for Permian assets. Next, want to look at one of our favorite energy stocks over the last couple of years, Devon Energy Corporation, ticker DVN. This one made us a lot of money over the last couple of years, especially in that dividend here of 7.4%, probably the highest dividend yield in the energy space, and really some of the best dividend growth we've seen in energy stocks. We can see here on slide 5 of Devon Energy's most recent quarterly performance presentation here, its asset map. Now, Devon is a little bit more diversified across different areas than we saw with Permian Resources. It does have some here in the Powder River, Anadarko, Eagle Ford shale deposits, as well as that Delaware Basin. So if we're looking for an acquirer that only wants those Permian Resources, that might bring Devon Energy a little bit lower on the list. We can, if we go back to that chart though, we can still see that Devon is the fifth largest acreage owner there in Permian. So it does have significant Permian resources, 400,000 acres there, and 15 rigs on those assets. And we can see here it has been expanding on that asset, building from 42 wells in the first quarter of this year all the way up to 76 wells, basically just in one quarter. So 34 net wells there in the second quarter, really increasing its exposure to this Delaware Basin, to the Permian region. One of the things I want to look for as I'm researching this topic is the well productivity and the efficiency the drilling efficiency of these companies. As we said, it is getting harder to get the remaining resources, the remaining oil out of these shale deposits, out of the Permian Basin. It is getting more difficult, more costly to extract the remaining oil from that. So we want to look for the companies that have that competitive advantage in their efficiency, in their productivity. We do see here that Devon has seemingly a competitive advantage in that well productivity on cumulative oil volumes drawn out. It's above 30% above that peer average. Drilling efficiency continues higher from 2020 all the way through 2023 year to date, 24% improvement in their drilling efficiencies. So not only are they expanding their asset map there in the Permian, but they're getting more efficient at completing those wells, and drilling those, and bringing out the oil. Last point I want to look for, and then we'll look at the valuation for Devon Energy, is the break-even funding level, or the break-even productivity on these. Okay, we see here that the break-even funding level for oil is $40, oil price of $40 on the West Texas Intermediate. So that is the American benchmark for oil there, not Brent. It's the West Texas Intermediate. We want to look for that in each of these companies. Here we see $40 oil price. Right now we know oil is right around $85 a barrel, so we see a huge cash flow potential for Devon Energy as it brings this oil out of the Permian region and out of all of its fields at a cost basis of $40, and then has that cash flow potential all the way up to $85. We want to look for that because that is a very clear demonstration of the productivity and the efficiency of these. That's what an acquirer is going to look for. It's going to look for cheaper assets that are cheaply pulled out of the ground and can add to its own assets at a cheap basis. And if we do look at the valuation here for Devon Energy on Yahoo Finance, price to sales ratio of 1.77, that is just slightly below Permian Resources, basically about the same. It is a little bit lower than the shares hit last year, 2.1, 2.3. Devon Energy did have to pull back on its dividend growth, protect that cash flow a little bit to be investing more capital expenditures into its field. So we did see a little bit lower investor sentiment on these. That's why we saw the price to sales valuation multiple. Investors weren't ready to pay quite as much for that stock if it was going to be slowing down its dividend growth. So we did see it fall from about 2.3, 2.1 times price to sales last year, down as far as 1.6 this year, but now up to about almost 1.8 times. Next is Diamondback Energy, ticker FANG, another stock that we've been investing in over the last couple of years, made us a lot of money when those oil prices rebounded after the pandemic. Here we see a dividend yield of 4.2%. All these energy stocks, oil stocks, sending that cash flow back to investors through these dividends. FANG's dividend yield, they're not quite as high as Devon Energy, but it's still a very respectable, very strong dividend yield for that company. Here we see the asset map for Diamondback, and we see it is much more concentrated there in the Delaware Basin, in the Midland Basin, there in the Permian region. So that leads me to believe that this could be one of the top acquisition targets. Okay, this is very much exposed to the Permian Basin. If we go back to this chart on Permian Resources here, 508,000 net acres there in the Permian region, 15 drilling rings. That makes it the fourth largest company. And we already know PXD was bought out. Occidental seemed to rebuff some acquisition attempts by Chevron earlier this year. It might be getting a little bit pricey. Warren Buffett definitely isn't one to sell quickly. EOG Resources also there, but then we have FANG, Diamondback Energy here. Going back to this asset map, we also see up here that break-even point is $50 a barrel for Diamondback Energy. Now that is a little bit higher than Devon, and the reason this is those shale deposits, those shale assets there in the Permian Basin. It is obviously a little bit more expensive to extract that oil from the ground than some of those conventional fields, some of those other oil assets that Devon has outside of the Permian region. So that is why Devon has a little bit lower cost of production there as far as its oil. Diamondback here at $50 a barrel, still very, very much cash flow positive with oil at $85 and up. Even if oil were to come down to $70, $75 a barrel, Diamondback would be able to sustain that dividend, sustain that share repurchase program, and be very much cash flow positive. One of the other things I like about Diamondback here is it has continued to improve on its proved reserve growth. Okay, it grew proved reserves at 14% year over year last year. That's as a lot of energy companies, especially in the Permian Basin, have seen their reserves slow down or even stop. 47% average annual cumulative average annual growth rate here, but we know that has slowed down even for for Diamondback, but still 14% increase in reserves over the last year is still very strong. We also see here that oil is 53% of its reserves. That is very, very important for a lot of these oil stocks, a lot of these energy plays. You want to look for how much is natural gas, how much is natural gas liquids, and how much is oil. Okay, because what we're talking about here is that demand for oil, the demand for oil from those Permian assets, and that is what the acquirers are buying. So we want an oil-rich company that is approved, that is increasing its reserves and is economical at these prices. And unfortunately, we do see all of this come out in the valuation for Diamondback Energy, ticker FANG there. Price to sales multiple right now about 3.5 times, so very much higher, about twice of what we've seen with these other companies, trading at around 1.8 times price to sales, 3.5 times on a price to sales basis, because the market does see everything that we're looking at here. The market sees those improving reserves. It sees a very much concentrated oil exposure to the Permian region. It sees a $50 per barrel production cost. It sees an acquisition target here in Diamondback Energy. So 3.5 times price to sales, that is even higher than where it was last year, 2.5 times, right around there. So it is trading at a steep premium to where it was even last year. Next up here, Occidental Petroleum, ticker OXY. We know that this is Warren Buffett's favorite oil stock. Buffett's Berkshire Hathaway now owns 25% of this company. So any acquisition of this company would definitely have to go through Warren Buffett and have to get his approval. He owns about $14 billion worth of this company. It is a $56 billion company, and so one of the larger oil companies there. But one of the things I do kind of wonder about, if we looked at this asset map, the combined asset map for Occidental Petroleum, for OXY, is we see it is very much a diversified, integrated oil company. Not only does it have those Permian unconventional assets that we're looking for, but it also has offshore in the Gulf of Mexico. It has traditional oil assets in the Rockies there. It has chemicals there with OxyChem. It has midstream elements with pipelines and that. So it is very much more a large integrated oil company already. Occidental is one of the largest U.S. acreage holders for drillers in the U.S. Here we can scroll down here. Just the Permian assets at 2.8 million acres. They're just in the Permian Basin. Another 1.1 million there in the Rockies. If we come back here now, this research does say 1.4 million, so you do have to double check this research put out by other companies, but that still makes it the second largest Permian Basin assets there in the country. And looking at productivity for Occidental, we do see improving productivity, which is very surprising given probably the age of some of these assets. But here we see the red line here is 2023 Wedge Wells productivity there for the company, for Occidental, and it is an improvement over 2022, over the 2017 through 2021 period. So it is actually improving on its well design and operational experience to drill and get more of that oil out of the ground. And that's why it is so surprising. This was only trading for about 2 times on a price to sales basis, so quite a bit under what we saw with Diamondback at a 3.5 times, right around maybe a little bit more expensive than some of those other oil stocks we looked at 1.8 times price to sales. But it is trading at a premium of where it was trading last year. Last year trading for 1.8, 1.7 times, even as low as 1.65 times on a price to sales. So it is trading, Occidental is trading for a premium on its price to sales valuation, trading a little bit more expensive than it has in the past. But it does have that improving productivity. It has that very strong asset map there in the Permian Basin, which would be our target right now, as well as other assets around the world. Last up here, another focused producer there in the Permian Basin, the Matador Resources Company, ticker MTDR. Now, this is only a $7.5 billion company, so it makes me wonder if a lot of the larger oil companies are looking for these large acquisition targets, the larger companies like FANG, like Occidental, like Devon, that are going to add materially to their resources there in the Permian Basin. Matador and some of these other smaller companies might not do that. We do see that they are open to these smaller acquisitions, but really they want to put on that big size from just one acquisition. We do see here Matador only offering a 1% dividend yield, so not quite as attractive as a Diamondback, as a Devon Energy. We see here the asset map on the company's presentation is very much focused there in in Texas, in that Permian Basin. It does have some Eagle Ford exposure, some Haynesville, Cotton Valley exposure, but most of it is there in the Delaware Basin. We can go back to this Permian Resources map and see that Matador is on here. It is a smaller player, 148,000 acres there, and just six drilling rigs there in the Permian. But that does make it a contender. That does make it an acquisition target. But that is only if an acquirer can get a good price on those assets. It is trading right now at 2.65 times price to sales. Now it does trade usually at a premium, a little bit higher than some of these other stocks, 2.3 times, 1.8, 1.9 times price to sales last year. But right now, 2.65 times on a price to sales basis for Matador. It is at a premium at its own historical average, and at quite a bit of premium to some of these other stocks that we've looked at. So if we are looking at potential acquisition targets in this theme, a larger company like a ConocoPhillips, like a Chevron coming in, trying to build their reserves in the Permian Basin, I would look closer at these Permian Resources, ticker PR, Devon Energy, ticker DVN, and Diamondback Energy, ticker FANG. All three of those significant Permian assets, a reasonable price on those shares on a price to sales valuation. I like Devon and I like Diamondback a little bit better on those dividend yields. You get a little bit higher dividend while you wait for these shares to go higher on an acquisition. Stay up to date with all the stock market news, strategies, and trends you need to see with the newsletter and the link below. Or click on the video here for the electric vehicle stocks that the market has forgotten but could double your money over the next 5 years. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.